Widespread deception can create rapid, albeit unethical, wealth accumulation. Historical scams are frequently fueled by a combination of greed, misplaced trust, and ultimate betrayal. The promise of easy money often blinds individuals to the underlying risks and fraudulent nature of such schemes. Examining past scams provides insights into the psychological vulnerabilities that fraudsters exploit. 17th century Amsterdam serves as the historical backdrop for tulip mania. The city's vibrant atmosphere and growing obsession with tulips set the stage for economic speculation. Tulip mania was a period of speculative frenzy in the Netherlands during the Dutch Golden Age. The period was characterized by an irrational exuberance for tulip bulbs, driving prices to unprecedented levels. The bustling streets of Amsterdam reflected the widespread obsession with tulips during this era. During the early 1600s in the Netherlands, tulips rose to prominence as status symbols. The rarity and unique beauty of tulips contributed to their desirability and high value. As tulips became more coveted, their prices began to inflate rapidly. This rapid price increase led to a speculative bubble known as tulip mania. Speculators invested heavily in tulip bulbs, hoping to profit from the escalating prices. The unsustainable inflation of tulip prices eventually resulted in a market crash. Rare tulip bulbs experienced a dramatic surge in price. Bulbs were traded for sums equivalent to grand houses. Some bulbs fetched prices comparable to entire merchant fleets. The exorbitant prices reflected the speculative frenzy surrounding rare tulip varieties. The Semper Augustus tulip bulb was a highly prized variety during the Dutch tulip mania. During the peak of tulip mania, a single Semper Augustus bulb was valued equivalent to a luxurious canal house in Amsterdam. The extreme price of the Semper Augustus exemplifies the speculative bubble that characterized tulip mania. The Semper Augustus tulip serves as a historical example of irrational market exuberance and financial risk. In February 1637, the tulip market experienced a sudden and dramatic collapse. The collapse of the tulip market triggered widespread panic among investors. Many investors faced financial ruin as a result of the tulip market crash. The tulip market collapse serves as a historical example of speculative bubbles and their potential consequences. Tulip mania represents one of history's earliest recorded speculative bubbles. This event vividly illustrates the potential dangers of unchecked human greed. Irrational exuberance played a significant role in driving the tulip mania bubble. The rapid inflation of tulip bulb prices was unsustainable, leading to an inevitable collapse. The tulip mania serves as a cautionary tale about market speculation. Understanding tulip mania provides valuable lessons for modern financial markets. The South Sea Bubble was an ambitious scheme promising fortunes through empire and trade. The South Sea Bubble aimed to generate wealth through overseas trade and imperial expansion. The South Sea Bubble was a financial scheme that occurred in London a century later. The South Sea Bubble was an ambitious scheme. The South Sea Company was founded in 1711. The company was established to manage England's national debt. The South Sea Company aimed to reduce debt through trade with South America. Trading with South America was intended to generate profits and alleviate the national debt. The company's initial purpose was to consolidate and reduce the national debt through exclusive trading rights. The South Sea Company's model involved converting government debt into company stock. Investors were promised enormous profits from exotic markets. The allure of gold, silver, and spices served as a primary enticement for investors. Exotic markets were portrayed as rich with opportunities for substantial financial gain. Promises of high returns were used to attract investment in these markets. The script emphasized the potential for significant profits to entice potential investors. Limited trade opportunities existed due to England's conflict with Spain. Spain controlled a significant portion of South America, restricting trade access. England's war with Spain directly impeded potential trade partnerships. The conflict created a trade blockade, severely limiting economic exchange. Actual trade volume was minimal due to these geopolitical constraints. These limitations significantly impacted economic growth and development. Company directors engaged in insider trading to manipulate stock prices. False statements and deceptive practices were used to create a speculative fever around the stock. Inflated stock prices led to an artificial increase in the company's perceived value. The artificial inflation of stock prices created a speculative bubble. Alexander Pope described speculative bubbles as superficially attractive but fundamentally insubstantial. The allure of a bubble lies in its visual appeal, masking its inherent lack of intrinsic value. The air inside symbolizes the unsubstantiated promises and inflated expectations driving the speculative frenzy. Pope's analogy underscores the importance of discerning genuine value from fleeting appearances in financial markets. The bubble's transient nature serves as a cautionary reminder of the risks associated with speculative investments. This metaphor highlights the potential for deception and the need for critical evaluation in assessing investment opportunities. Government actions can create the illusion of official endorsement for private entities. Laws passed by the government can be perceived as an endorsement of a company's activities. Allowing a company to take over a nation's debt can create a false impression of government support. This government endorsement illusion can mislead the public regarding the true relationship between government and company. The illusion may lead to increased public trust and investment in the endorsed company. However, this perceived endorsement does not guarantee the company's long-term success or ethical behavior. In late 1720, the South Sea bubble illusion shattered. Shares of the South Sea Company experienced a dramatic crash. The bursting of the bubble wiped out fortunes overnight. The rapid collapse led to widespread financial ruin and social unrest. The scandal exposed deep government corruption. The corruption scandal shook public trust. Investigations were launched to uncover the extent of the corruption. Trials were conducted to hold those responsible accountable. The South Sea bubble exemplifies human greed and the desire for rapid wealth accumulation. The allure of quick riches was a central driver of the South Sea bubble. The South Sea bubble serves as a historical precedent for later financial scams. Recurring themes of greed and the promise of easy money are evident across various financial scams throughout history. Charles Ponzi introduced a scheme promising to double investors' money within 90 days. The Ponzi scheme operated in Boston during the 1920s. The scheme attracted investors with the promise of exceptionally high returns in a short time frame. The core concept involved using new investor funds to pay returns to earlier investors. The Ponzi scheme's sustainability depended on a continuous influx of new investors. Ponzi schemes promise high returns by exploiting arbitrage opportunities, such as international postal coupons. In reality, Ponzi schemes operate by paying returns to earlier investors using capital from new investors. The promised returns are not generated from legitimate business activities or investments. This unsustainable model collapses when new investments slow down, leaving later investors with significant losses. Public belief in Ponzi schemes stems from the allure of quick and effortless wealth. The promise of easy wealth drives individuals to invest without thoroughly investigating the underlying mechanisms. Crowds lined up to invest, fueled by the perceived opportunity for rapid financial gain. The allure of Ponzi schemes lies in the illusion of easy money, masking the unsustainable nature of the investment. Ponzi's scheme collapsed as the cash needed to pay returns exceeded his ability to deliver. The unsustainable payout structure led to an inevitable cash flow crisis. The inability to meet promised returns triggered the scheme's exposure and subsequent downfall. Ponzi's arrest marked the formal end of the fraudulent investment operation. Despite public awareness, Ponzi schemes continue to emerge globally. Variants of Ponzi schemes adapt to exploit different markets and investor demographics. The core mechanism of a Ponzi scheme remains consistent, paying early investors with money from new investors. Public exposure and legal actions have not eradicated the appeal of high, unsustainable returns. The universality of Ponzi schemes highlights the persistent human desire for quick and easy wealth. The allure of guaranteed wealth is a primary psychological driver behind participation in Ponzi schemes. The fear of missing out, FOMO, significantly increases susceptibility to Ponzi scheme solicitations. The hope of being lucky and achieving quick financial gains motivates individuals to invest in Ponzi schemes. These psychological factors often override rational assessment of investment risks. Ponzi schemes exploit inherent human biases related to greed, social pressure, and optimism. Understanding these psychological drivers is crucial for preventing and mitigating the impact of Ponzi schemes. In 1932, the Australian government initiated a military operation against a large emu population. This conflict, known as the Great Emu War, involved deploying soldiers to control emu damage to crops. The Emu War arose from concerns about the large emu population impacting agricultural lands. The operation aimed to reduce the number of emus and mitigate the damage they caused to agricultural lands. The Great Emu War represents an unusual instance of military involvement in wildlife management. Thousands of emus migrated to farmland in Western Australia. The emus caused significant damage to crops. The emus also destroyed fences on the farmland. The emu migration resulted in substantial agricultural losses. The government deployed armed soldiers to engage the birds. The military response involved direct confrontation with the avian threat. Machine guns were used in an attempt to battle the birds. The government's reaction was to treat the birds as enemy combatants. This military engagement was framed as a battle against the birds. Emus demonstrated remarkable agility and resilience throughout the conflict. The emu's ability to outmaneuver troops contributed significantly to the military campaign's failure. The military campaign was ultimately unsuccessful due to the emu's strategic advantages. The emu's natural adaptations allowed them to thrive despite military intervention. The Emu War highlighted the unexpected challenges of wildlife management in military operations. The media portrayed the event as an absurd debacle. This portrayal eroded public trust in the government. The media coverage emphasized the government's inability to solve the problem effectively. Sensationalized reporting amplified the perception of government incompetence. The public's confidence was undermined by the negative media narrative. The media's focus on the debacle overshadowed potential solutions or positive outcomes. The Great Emu War exemplifies how misinformation can distort public understanding of events. Government missteps can lead to unintended consequences and public skepticism. Historical narratives are susceptible to embellishment and biased reporting. Public perception can be manipulated through selective presentation of facts. Analyzing historical events requires critical evaluation of sources and awareness of potential biases. At the dawn of the 20th century, Enron emerged as a prominent entity in the energy sector. Enron's image as a shining star concealed underlying unethical practices. The company's rapid ascent was built upon a foundation of concealed financial irregularities. Enron's story serves as a cautionary tale of corporate overreach and deceptive accounting. Enron utilized accounting tricks to conceal debts and artificially inflate profits. Mark-to-market accounting was used to book potential future profits immediately, regardless of actual earnings. Special purpose entities, SPEs, were established to hide large amounts of debt off Enron's balance sheets. These SPEs were often controlled by Enron executives, creating conflicts of interest and enabling further manipulation. By hiding debt and inflating profits, Enron presented a falsely positive financial picture to investors and the public. The use of these accounting loopholes ultimately contributed to Enron's collapse and significant financial losses for stakeholders. Sharon Watkins alerted CEO Kenneth Lay to significant financial and accounting irregularities within Enron. The warning highlighted potential accounting malpractices that could severely impact the company's financial stability. Watkins' communications served as a critical internal alert regarding the company's precarious financial position. The whistleblower's warning underscored the importance of ethical governance and transparency in corporate operations. This internal communication aimed to prevent further damage and prompt corrective action to address the identified issues. Analysts and journalists began in-depth investigations into Enron's financial practices. Increased scrutiny revealed inconsistencies and irregularities within Enron's reported earnings. The exposure of accounting loopholes and hidden debts triggered a loss of investor confidence. The facade of Enron's success began to crumble under the weight of these revelations. As the truth emerged, Enron's stock price plummeted, leading to a rapid decline in market capitalization. The culmination of these factors resulted in Enron's bankruptcy, marking one of the largest corporate collapses in history. Enron's bankruptcy resulted in significant job losses for its employees. Many Enron employees lost their retirement savings due to the company's collapse. The Enron scandal led to a widespread loss of trust in corporate America. The loss of trust extended to the accounting practices of large corporations. The Enron collapse triggered stricter regulations and oversight of financial markets. The scandal prompted increased scrutiny of executive compensation and corporate governance. The Enron scandal triggered widespread reforms aimed at enhancing corporate transparency. The Sarbanes-Oxley Act was enacted to increase accountability within corporations. These reforms sought to prevent future financial misconduct and protect investors. Increased transparency allows for better monitoring of financial activities. Enhanced accountability ensures that corporate executives are responsible for their actions. Enron's story serves as a stark reminder of the potential for greed and deception to undermine even the most powerful organizations. The Enron scandal illustrates how institutional corruption can lead to catastrophic consequences. Greed and deception within Enron eroded trust and ultimately led to the company's downfall. The Enron case highlights the importance of ethical leadership and transparent financial practices in maintaining corporate integrity. The Enron scandal underscores the need for robust regulatory oversight to prevent similar corporate failures. Bernie Madoff was initially regarded as a respected financier on Wall Street. Madoff served as the former NASDAQ chairman, further enhancing his credibility. Unbeknownst to many, Madoff operated a hidden Ponzi scheme. The Ponzi scheme was concealed beneath a veneer of financial success and regulatory compliance. Madoff's scheme ultimately defrauded investors of billions of dollars. Madoff attracted investors by promising steady and impressive returns. Madoff's reputation and exclusivity were key factors in attracting thousands of investors. The promise of consistent profitability was central to Madoff's investment strategy. Investors were drawn to Madoff's fund due to the perception of low risk and high reward. Madoff's scheme operated as a Ponzi, utilizing new investor funds to pay existing investors. The core mechanism involved attracting new investors to sustain payouts to earlier investors. The scheme masked substantial losses by falsely reporting investment gains. As new investments slowed, the scheme became unsustainable, leading to its collapse. The illusion of profitability was maintained through fraudulent financial statements. The scheme's success relied on trust and the promise of consistently high returns. The 2008 financial crisis intensified, leading to widespread economic instability. Investors, facing mounting losses, began withdrawing funds from various investment schemes. Increased fund withdrawals placed immense pressure on fraudulent schemes, such as Madoff's Ponzi scheme. The financial crisis exposed Madoff's scheme as investors demanded their returns. The exposure of Madoff's scheme triggered a wave of investigations and legal proceedings. The Madoff scandal served as a stark reminder of the risks associated with unregulated financial activities. The fraud resulted in losses exceeding $65 billion, marking it as the largest financial fraud in history. Victims of the fraud ranged from major Wall Street institutions to individual retirees. The scale of the fraud impacted a diverse range of financial stakeholders. The financial fallout had devastating consequences for both institutions and individuals. The sheer magnitude of the fraud underscores the importance of financial regulation and oversight. The fraud serves as a stark reminder of the potential for systemic risk in financial markets. Madoff admitted to causing massive harm through his fraudulent scheme. Madoff's actions represented a profound betrayal of trust for investors. Questions remain regarding how Madoff evaded detection for an extended period. The scale of Madoff's deception highlights vulnerabilities within the financial regulatory system. The long duration of the fraud raises concerns about oversight mechanisms. The Madoff case underscores the importance of vigilance and robust regulatory frameworks. Madoff's established reputation contributed significantly to his success. The promise of consistent profits created an allure that attracted investors. The fear of missing out, FOMO, drove many to invest, hoping not to be left behind. These psychological forces combined to create a powerful investment dynamic. The illusion of exclusivity amplified the desire to participate in Madoff's scheme. Social proof and trust in Madoff's network further fueled investment. Madoff's scandal serves as a stark warning about the potential dangers of misplaced trust. The scandal highlights the immeasurable damage that occurs when trust is fundamentally broken. Misplaced trust can lead to significant financial and emotional devastation for individuals and institutions. The Madoff case underscores the importance of due diligence and independent verification in financial dealings. Regulatory oversight and ethical conduct are crucial in preventing similar fraudulent schemes. The scandal emphasizes the need for continuous vigilance and skepticism in financial markets. Scams exploit trust, a fundamental element in human interactions. Hope is a key motivator that scammers leverage to lure victims. Scams are not solely about monetary gain, but also about manipulating emotions. Throughout history, the themes of trust and hope have been central to fraudulent schemes. Scammers often build rapport to establish a foundation of trust before executing their schemes. The allure of quick riches or easy solutions fuels the hope that scammers exploit. Greed can obscure judgment, leading to a distorted perception of reality. The pursuit of wealth can create a barrier to recognizing and accepting the truth. Truth is often compromised or ignored when greed becomes the primary motivator. An excessive desire for material gain can cloud one's moral compass. Ethical considerations are often sacrificed in the relentless pursuit of profit. The blinding effect of greed can lead to the suppression or manipulation of factual information. Individuals often avoid truths that challenge their pre-existing beliefs and illusions. Facing uncomfortable truths can shatter illusions, leading to cognitive dissonance and emotional distress. The avoidance of truth serves as a defense mechanism to protect one's self-perception and worldview. Nietzsche's perspective suggests that the comfort of illusion often outweighs the pain of confronting reality. This avoidance can hinder personal growth and prevent a deeper understanding of the world. Ultimately, embracing truth, however painful, is essential for intellectual honesty and genuine self-awareness. Vigilance is crucial due to the rapid proliferation of scams in the modern digital environment. Scams can spread quickly through various digital channels, necessitating constant awareness. Maintaining vigilance helps protect against financial losses and identity theft resulting from scams. Staying informed about common scam tactics is an essential component of vigilance. It is important to question who benefits from a deal that appears excessively favorable. Analyzing the beneficiaries reveals potential hidden costs or negative consequences. A deal's true value must be assessed by considering all associated costs. Unfair deals often transfer value from one party to another. Transparency in transactions helps to expose potential exploitation. Critical evaluation is essential to ensure equitable outcomes. Blind trust can create vulnerability to scams. Scams often exploit the inherent human tendency to trust others. Lack of verification and critical thinking can lead to falling victim to fraudulent schemes. Scammers use sophisticated techniques to manipulate emotions and gain confidence. Protecting oneself requires skepticism and due diligence in all interactions. Remaining vigilant and informed is crucial in preventing scams. Scams often exploit people's fears and vulnerabilities. Scams also capitalize on people's hopes and desires for a better future. Understanding the psychological basis of scams helps individuals recognize and avoid them. Recognizing the patterns of manipulation is crucial in breaking the cycle of scams. Awareness and education are key tools in preventing individuals from falling victim to scams. By acknowledging the emotional drivers behind scams, individuals can make more informed decisions. Gratitude is expressed for viewership and engagement. An invitation is extended to like the video. Viewers are encouraged to subscribe for future content. The audience is prompted to enable notifications by hitting the bell icon. The video series focuses on the intersection of history and truth. Continued support ensures more stories, exploring historical accuracy. The scene opens with a transition to 17th century Netherlands, setting the stage for tulip mania. Visual elements establish the historical context of the Dutch Golden Age. The visual narrative introduces the initial prosperity and economic activity of the era. Symbolic representation of the rising economic tide through visual metaphors. Introduction of tulips as a novel and exotic commodity. The scene subtly foreshadows the speculative nature of the emerging tulip market. Exponential growth in tulip bulb prices during tulip mania is visually represented through charts. Graphs illustrate the dramatic rise and subsequent fall of tulip bulb values during the tulip mania period. Visual representation emphasizes the unsustainable nature of the price surge in the tulip market. Comparative charts display tulip bulb prices against other commodities to highlight the anomaly. The Semper Augustus bulb was a highly prized commodity during the Dutch tulip mania. Its value was equivalent to that of houses, land, and other significant assets. The trade of the Semper Augustus bulb exemplifies the speculative nature of the tulip market. Visual representation of the assets that one Semper Augustus bulb could be traded for. The high price reflected its rarity and the intense demand from collectors and investors. The Semper Augustus became a symbol of extreme wealth and speculative investment. A sudden market collapse is characterized by a rapid and significant decline in asset prices. Panic selling exacerbates the collapse as investors rush to liquidate their holdings. The plummeting prices trigger margin calls, forcing further liquidations and amplifying the downward spiral. Market collapse can lead to widespread financial instability and economic recession. The scene transitions to London, setting the stage for the historical context of the South Sea bubble. Visual elements establish the era and location, providing a backdrop for the unfolding financial events. The introduction of London serves as a prelude to the narrative of the South Sea bubble. This historical setting is crucial to understanding the origins and impact of the South Sea bubble. The visual transition emphasizes the importance of location and time in the South Sea bubble story. The South Sea Company promised immense profits from South American trade. Visual representations of the company's promises were used to attract investors. These promises centered on the potential riches of South American resources. The company's marketing emphasized the vast, untapped potential of South American markets. Investors were lured by the prospect of quick and substantial returns. The South Sea Company's stock prices experienced a rapid increase. Charts and graphs visually depict the inflated stock values. Visual representations highlight the unsustainable growth of the stock. Data visualization tools illustrate the exponential rise in stock prices. The visual depiction emphasizes the dramatic surge in the company's valuation. The rapid increase in stock prices is visually represented through escalating charts. Government corruption involves abuse of entrusted power for private gain. Scandals often emerge following the collapse of economic bubbles, revealing underlying corrupt practices. Corruption can manifest through bribery, embezzlement, and fraudulent activities within governmental systems. Such corruption undermines public trust and destabilizes economic structures. The scene transitions to Boston in the 1920s, setting the historical context. Charles Ponzi is introduced as a central figure in this historical setting. The visual introduction establishes Ponzi's presence within the vibrant economic environment of the time. The setting of 1920s Boston is crucial for understanding the environment in which Ponzi's scheme unfolded. A Ponzi scheme operates by paying profits to earlier investors with funds from more recent investors. The scheme collapses when new investments cannot sustain the promised returns to existing investors. Early investors are incentivized to recruit new investors, accelerating the scheme's growth. The illusion of high returns attracts more investors, creating a self-perpetuating but ultimately unsustainable cycle. Large groups of people are visually depicted lining up to invest. The visual representation emphasizes the scale of participation in the investment scheme. Visuals capture the eagerness and enthusiasm of the crowd. The investment scheme is visually presented as an attractive opportunity. Visuals depict the flow of money from the crowd into the investment scheme. The overall scene visually conveys the widespread appeal of the Ponzi scheme. Authorities apprehend Charles Ponzi, marking the beginning of the scheme's unraveling. The Ponzi scheme's collapse ensues as investors demand their returns, revealing the unsustainable structure. News headlines and articles expose the fraudulent nature of Ponzi's investment strategy. Legal proceedings commence, revealing the intricate web of deceit and financial mismanagement. Investors face significant financial losses as the Ponzi scheme is exposed. The scene transitions to Australia, setting the stage for the introduction of the Great Emu War. The Great Emu War is a historical event that occurred in Australia. This event involved military intervention against a large population of emus. The conflict arose due to emus causing crop damage and economic concerns. The Great Emu War serves as a notable example of human-wildlife conflict. Emu invasions involve large numbers of emus entering agricultural areas. These incursions often result in significant damage to crops and agricultural infrastructure. Emus consume and trample crops, leading to economic losses for farmers. The large size and mobility of emu flocks make them difficult to control and deter. Protective measures, such as fencing, are often employed to mitigate the impact of emu invasions. Emu invasions pose a challenge to maintaining agricultural productivity and sustainability. Soldiers are shown engaging emus with machine guns in a military campaign. The visuals depict an attempt to combat emus using military weaponry. The scene illustrates the military's efforts to control the emu population. The campaign involves the use of machine guns to engage the emus. Enron was initially perceived as a highly successful energy company. The company held a dominant position in the energy sector. Enron's rapid growth and innovative business models contributed to its initial success. The company's image was one of stability and financial strength. This perception masked underlying financial issues that would later lead to scandal. Enron employed accounting tricks to obscure its financial liabilities. These accounting methods were used to conceal debt from the balance sheets. Special purpose entities, SPEs, were used to hide large amounts of debt. These methods artificially inflated Enron's stock price. The accounting tricks ultimately led to Enron's collapse. Enron's bankruptcy resulted in significant financial losses for employees and investors. The collapse of Enron led to widespread job losses and shattered retirement savings. Enron's fraudulent accounting practices were a primary cause of its downfall. The Enron scandal triggered increased scrutiny of corporate governance and accounting regulations. The aftermath of Enron's bankruptcy included numerous legal battles and criminal prosecutions. Wall Street serves as the introductory backdrop to Bernie Madoff. The visual transition focuses on the financial district. Bernie Madoff is introduced as a key figure. The scene establishes the setting and the central character. The transition visually links Madoff to the world of high finance. The setting and character introduction are visually integrated. Madoff's Ponzi scheme operated by attracting new investors and using their funds to pay purported returns to existing investors. The scheme lacked legitimate investments or profit-generating activities. Payouts were solely dependent on continuously attracting new capital. As the investor base grew, the required influx of new funds to sustain the payouts became exponentially larger and increasingly unsustainable. The illusion of profitability was maintained through falsified account statements and fabricated trading activity. The scheme collapsed when new investments dwindled, and Madoff could no longer meet the redemption requests of existing investors. Visuals depict Madoff's arrest, highlighting the gravity of his crimes. The scene illustrates the devastating impact of Madoff's Ponzi scheme on his victims. Victims of Madoff's fraud suffered significant financial and emotional distress. The visuals serve as a stark reminder of the consequences of financial fraud. Scams frequently exploit human greed through promises of disproportionate returns. Trust is a key element that scammers manipulate to gain victims' confidence. Deception is central to scam operations, often involving elaborate false pretenses. Recurring scam themes include impersonation, investment fraud, and phishing. Visual cues can help identify and avoid falling victim to fraudulent schemes. Vigilance is encouraged through continued learning and awareness. Viewers are invited to engage further by liking the content. Subscribing ensures access to more content and supports the channel. Continued support helps create more educational resources. Thank you for watching and contributing to the learning community.